Do you want to turn $10,000 into $217,000? Do you want a system that multiplies your wealth? Do you want time as your greatest ally? The answer is simple. Start investing today. Let compound interest work for 40 years. Why does this work? This slide explains everything. Assume you invest $10,000 at 8% annually. After 10 years, $21,589, about double. After 20 years, $46,610, about 4.6 times. After 30 years, $100, $627, over 10 times. After 40 years, $217, $245, more than 21 times. Notice the critical pattern here. The first 20 years, $36,610 gain. The second 20 years, $170, $635 gain. The second half is 4.7 times the first half. Compound interest calculations are mathematical facts. However, whether the assumed return, such as 8% annually, continues in the future depends on the market and is not guaranteed. The S&P 500's long-term historical average is about 10%, but it fluctuates significantly year to year. And this is an achievable scenario. Invest $10,000 today. For example, a U.S. stock index fund is one option, but choose based on diversification across countries, currencies, asset classes, and consider fees, taxes, and currency risk. Make time your ally for 40 years. This has the potential to change your future. Today, let me show you the mathematical foundation. The wealthy don't do complex calculations. They use one formula. The rule of 72. This is remarkably simple. Divide 72 by your annual return rate. That alone gives you the approximate time for your money to double. At 8% annually, 72 divided by 8 equals 9 years. At 10% annually, 72 divided by 10 equals 7.2 years. At 6% annually, 72 divided by 6 equals 12 years. Your $10,000 becomes $20,000 in 9 years at 8% annually. Another 9 years, $40,000. Another 9 years, $80,000. How many times does it double in 40 years? About 4 times. $10,000 becomes over $160,000. The rule of 72 is an approximation formula that quickly estimates doubling time. The exact value uses logarithmic calculation, with error varying by return rate. But it's a powerful tool to accelerate investment decisions. Just knowing this formula gives you the same thinking framework as the wealthy. Here's the most critical point. Compound growth is not linear. It's exponential. In the first 10 years, $10,000 grows by $11,589. The next 10 years grows by $25,021. The following 10 years grows by $54,017. And the final 10 years grows by $116,618. Compare the first 10 years to the last 10 years. The last 10 years, growth is about 10 times the first 10 years. This is the essence of exponential growth. The first half requires patience. Growth feels slow, but in the second half, growth explodes. So don't stop midway. The last 10 years generate the maximum returns. Patience creates wealth. Assume you're 25 years old. You start investing $500 per month. At 8% annually, you continue for 40 years. On your 65th birthday, your account has about $1.75 million. What if you start at 45 instead? Same $500 per month. Same 8% annually. But only 20 years. On your 65th birthday, your account has about $290,000. The difference, about $1.45 million. Just 20 years difference in start time creates this gap. The difference in total invested? Starting at 25, $240,000 invested. Starting at 45, $120,000 invested. Difference, $120,000. But the wealth difference, $1.45 million. About 12 times. However, these calculations assume end-of-month contributions and 8% annual return compounded monthly. Results vary with calculation conditions, so understanding the assumptions is critical. One day today is worth thousands of dollars. You cannot buy time. Today is the youngest day you'll ever have. Want to build $600,000 in wealth? Just $500 per month. For 30 years, at 7% annually. $500 per month at 7% compound interest for 30 years becomes about $610,000. Total invested, $180,000. About 3.4 times. Think about this daily. About $17 per day of investment. 2 Starbucks lattes. Assume you're 30 years old now. Every day skip 2 Starbucks. Put that $17 into investments. On your 60th birthday, your account has over $600,000. Applying the 4% rule, you can withdraw about $2,000 per month for living expenses. This is a prudent amount you can use while preserving capital. For living on dividends alone, S&P 500 dividend yields are historically around 1.5 to 2%. Dividends from $600,000 would be about $750 to $1,000 per month. Life planning should be designed around withdrawal, including taxes and inflation, not just dividend yield. That's realistic. This starts with skipping today's latte. So how do you achieve financial freedom? There are 5 steps. Step 1. Define your goal clearly. Not, I want to be rich, but build $1 million in assets by age 40 inches. Define it specifically. Without numbers, no plan exists. Step 2. Optimize your income. Salary negotiation, side hustles, skill development. If income doesn't increase, the amount you invest cannot increase. Step 3. Manage your spending. Don't cut luxuries. Cut valueless expenses. Not Starbucks coffee, but unused subscriptions. Step 4. Start investing. Begin with $500 per month. Don't wait for perfect timing. Today is the best day. Prioritizing tax-advantaged accounts like NISA improves after-tax returns. Step 5. Review regularly. Rebalancing can be periodic, like once a year, or threshold-based, like when allocation deviates by X%. Decide based on taxes and trading costs. Markets change. Your strategy must evolve. These 5 steps are your wealth blueprint. Eliminate emotion. Follow the system. That alone gives anyone the potential to achieve financial freedom. $217,000 after 40 years. This is in nominal terms. But there's an invisible enemy, inflation. At 3% annual inflation over 40 years, purchasing power drops to about 31%. The real value of $217,000 equals about $67,000 in today's dollars. In 2022, U.S. CPI recorded a high plus 8.0% year over year. The Fed implemented rapid rate hikes, completely changing the interest rate environment. Recent years have seen rapid changes in inflation and interest rates, so nominal growth and purchasing power growth are different things. Investment decisions must view inflation, interest rates, and taxes together. Designing goals in real terms is critical. Only those who understand the nominal growth trap build true wealth. Now let's organize today's key points. Here's today's summary. First, the power of compound interest. $10,000 at 8% annually becomes about $217,000 in 40 years. The second 20 years, growth is 4.7 times the first 20 years. This is the pattern of exponential growth. Second, the advantage of early start. Starting at 25 versus 45 creates a wealth gap of about $1.45 million. A 20-year difference in start time changes your life decisively. Third, the value of time. The last 10 years, growth is about 10 times the first 10 years. Patience generates maximum returns. However, this is a mathematical model based on past data. Markets fluctuate, and returns are not guaranteed. You must also account for inflation, taxes, and fees in reality. Of course, markets have risks. Understand principal loss risk and consider it alongside emergency funds and debt management. But it's a far wiser choice than letting cash sit idle. Recently, specific mega-cap tech companies have been driving markets. S&P 500 alone is well diversified, but global diversification is also worth considering in this era. When will you start? Can you imagine a life of financial freedom? Share your wealth-building strategy in the comments. Your goals, your plans, your questions. Everything becomes this community's wisdom. Thanks for investing your time with me today. This channel provides actionable strategies for compound interest, asset allocation, and financial freedom, explained with numbers. You can achieve financial freedom. If you want the confidence to make it happen, subscribe to the channel. Turn on notifications too. Until next time.